everyone, welcome back to Corporate Decoder, the place where we take a peek behind the curtain of corporate filings, because let's be honest, who really understands what's going on in those things? Today we're diving into STEELCASE's latest 10K report. Think of it as their annual exam, but instead of a doctor, it's the Securities and Exchange Commission checking up on them. It was a year of some big wins for STEELCASE, but also some signs that they're fighting an uphill battle. We'll break it all down for you. First off, STEELCASE helps companies create office spaces, offering furniture and architectural products. They're like the interior designers for big businesses and schools. They operate globally, but mainly in the Americas and Europe, the Middle East and Africa, which they call EMEA and Asia Pacific. This report covers their performance up to February 2025. That might seem like ancient history, but it gives us a crucial look at how they were doing then and how that might affect their strategy today. Let's talk about what STEELCASE actually does. They don't just sell desks and chairs, they sell solutions. They try to understand how people work and then create spaces that make them more productive. Their strategy involves expanding into areas like education and healthcare, using digital tools to improve customer experience and partnering with their dealers to gain a competitive edge. They want to simplify processes, be efficient, and reallocate resources. Basically run a tight ship. STEELCASE's offerings are pretty broad. They sell furniture systems, seating, storage, desks, tables, and even interior architectural products like walls and pods. They also offer consulting services. They partner with companies like Microsoft and Zoom to market additional services to our dealers, to sell additional products and services to our dealers and customers. Here's where things get interesting. STEELCASE divides its operations into two main segments. In the Americas, sales to the US federal government are important, accounting for roughly 3% of their consolidated revenue. They aren't too reliant on a single customer. Their largest customer only makes up about 2% of their revenue. Every company has things that keep their leadership up at night. STEELCASE is no different. Changes in tariffs and global trade can really hurt them. Tariffs can impact the cost of importing their products and raw materials, which can squeeze their profit margins. They're vulnerable to raw material prices going up, things like steel, plastic, and wood. This could affect our profitability. Here's something to consider. STEELCASE doesn't have a backup plan for all its manufacturing. If one factory has problems, it could disrupt their whole operation. They rely on a network of independent dealers. If those dealers struggle, STEELCASE struggles. Operating in many countries brings risk due to currency exchange rate fluctuations and currency controls that can limit their ability to move money around. Then we have some accounting risks. They might have to write down the value of their goodwill, essentially admitting they overpaid for an acquisition. Every company is talking about cybersecurity these days. It's becoming an increasingly important issue. Scroll, wheel, use a combination of people, processes, and technologies to monitor and mitigate cybersecurity threats. The company's audit committee of the board of directors is responsible for the oversight of our cybersecurity risk management. That means this is a board level discussion. Revenues up slightly from $3,169.66 million and one money on bad, but not exactly setting the world on fire. Gross profit margin increased, rising from 32.1%. This means they're making a little more money on each product they sell. Operating income also increased from $117 and $17.28 million. A pretty $8 million, a pretty good sign that our operations are getting more efficient. Organic growth is flat at 2%, so real sales without counting some weird accounting are down. Earnings per share, a key measure of profitability, also went up from $0.08 to 1.020 cents. All in all, the company says their earnings improved. However, it seems like some of the gains are from gains on sales of land and favorable tax items. Higher gains on the sale of fixed assets, primarily land, higher revenue in the Americas, and lower restructuring costs, partially offset by higher variable compensation expense. A major reason for the profit jump was a lower tax rate. The Americas segment grew, but the international segment actually shrank. Revenue in the Americas is up, but international revenue is down. Other income expense net includes a $15.2 million settlement charge related to our defined benefit plan in the UK, so that was not great. The Americas segment revenue increased, driven by growth from large corporate, government, and education customers, so the core of the business is doing well. Organic growth in the Americas is a positive, 2%, driven by government and education. It means business is going well in the States. Adjusted operating income of $170.9 million represented an improvement of 12.22 compared to the prior year. It could be a sign that it's becoming more profitable for STEELCASE. Again, the devil is in the details. Operating expenses increased, mostly due to employee costs. International is the problem, as the operating loss in the international segment improved, but the adjusted operating loss of $12.5 million increased. Also, revenue is down. Organic decline in international is down 7%. Things don't look great overseas. Looking at the company's cash flow, STEELCASE cash position is increasing. Good sign for future stability. Capital expenditures decreased from $47 to $47 to $47 to grow, or found some efficiencies. STEELCASE has a $300 million line of credit, which is good for emergencies. The company has some material cash requirements. The biggest is the debt repayment due in 2029. In addition, there are operating leases and employee benefit and compensation obligations. This could mean a major change in their growth ambitions as their cash requirements change over time. Every company has to make estimates for STEELCASE. These estimates are the most important. Goodwill is basically an accounting measure of what they paid extra when they bought another company. They have to check each year to make sure that goodwill is still worth what they say it is. This is good. The company says in all the valuation it is worth the cost. Taxes are tricky, especially when you operate in many different countries. So the company also needs to estimate and make assessments for this. Also, the pension plans need a set of estimates to predict and measure costs. It's a very long-term estimate with a ton of assumptions. The final point worth highlighting are changes in currency exchange rate, which are always a headache for any company dealing in international revenue. STEELCASE uses fancy financial instruments to hedge. A fancy way of saying that company is insured if it goes wrong. If unsuccessful, it could definitely have an adverse effect on our business, operating results, or financial condition. Now, let's step back and look at the bigger picture. This report paints a mixed picture of STEELCASE. A core segment in the Americas is performing well, boosted by gains from smart asset sales. The international segment, however, is facing headwinds, leading to restructuring efforts. The company is doing what it can to streamline costs, manage risks, and position itself for future growth. But the uncertainties in the global economy and the workplace make it a tricky path to navigate. On the positive side, STEELCASE seems to have a strong handle on its core market in the Americas. We see some good strategic decisions that shows us some strength. However, they need to turn things around in the international markets and manage our debt, as well as manage our supply chain so there are no disruptions. The role, it seems like STEELCASE knows what it needs to do. We have to see execution to believe it. Thanks for watching. If you found this useful, please subscribe, like and comment for more deep dives into the world of corporate finance.